Welcome to Atcons, the easiest way to explore your journey of investing in stock market. Financial market. Financial market is the market where financial securities like stocks, bonds, and commodities like valuable metals are exchanged at efficient market prices. Here, by efficient market prices, we mean the unbiased price that reflects belief at collective speculation of all investors about the future prospect. The trading of stocks and bonds in the financial market can take place directly between buyers and sellers or by the medium of stock exchange. Financial markets can be domestic or international. What is a stock or share? The word stock or share simply means a share in the ownership of the company. Stock represents a claim on the company's assets and earning. When you own a share, you own some part of the company. The more shares you own, the bigger your stake and the more say you have. Once you hold the stock of the company, you will become the shareholder of that particular company. That is, technically, you own a tiny sliver of every piece of furniture, every trademark, and every contract of the company. Shares bring money into the company, which they invest for growth, expansion, and development. Different types of financial markets: capital market, derivatives market, commodity market, money market, foreign exchange or forex market, insurance market. Capital markets may be classified as primary markets and secondary markets. In primary markets, new stock or bond issues are sold to investors via a mechanism known as underwriting. In the secondary markets, existing securities are sold and bought among investors or traders, usually on securities. So, the capital market can be divided into bond market and stock market. Bond market provides financing by bond issuance and bond trading. Stock market provides financing by shares or stock issuance and by share trading. As a whole, capital market facilitates raising of capital. Primary market. The primary market is that part of the capital markets that deals with the issuance of new securities. Companies, governments, or public sector institutions can obtain funding through the sale of a new stock or bond issue. This is typically done through an association of securities dealers. The process of selling new issues to investors is called underwriting. In the case of a new stock issue, this sale is an initial public offering, IPO. Dealers earn a commission that is built into the price of the security offering, though it can be found in the prospectus. Features of primary markets are: this is the market for new long-term equity capital. The primary market is the market where the securities are sold for the first time, so it is also called the new issue market, NIM. In a primary issue, the securities are issued by the company directly to the investors. The company receives the money and issues new security certificates to the investors. Primary issues are used by companies for the purpose of setting up new business or for expanding or modernizing the existing business. The primary market performs the crucial function of facilitating capital formation in the economy. The new issue market does not include certain other sources of new long-term external finance, such as loans from financial institutions. Borrowers in the new issue market may be raising capital for converting private capital into public capital. This is known as going public. The financial assets sold can only be redeemed by the original holder. Initial public offering. An initial public stock offering, IPO, referred to simply as an offering or flotation, is when a company issues common stock or shares to the public for the first time. They are often issued by smaller, younger companies seeking capital to expand. It can also be done by largely privately owned companies looking to become publicly traded. In an IPO, the issuer may obtain the assistance of an underwriting firm, which helps it determine what type of security to issue, common or preferred, best offering price, and the timing to bring it to market. A company that is planning an IPO appoints lead managers to help it decide on an appropriate price at which the shares should be issued. There are two ways in which the price of an IPO can be determined. Either the company, with the help of its lead managers, fixes a price, or the price is arrived at through the process of book building. An IPO can be a risky investment. For an investor, it is tough to predict what the stock or shares will do on its initial day of trading and in the near future, since there is often little historical data with which to analyze the company. Also, most IPOs are of companies going through a transitory growth period, and they are therefore subject to additional uncertainty regarding their future value. Secondary market. Secondary market refers to a market where securities are traded after being initially offered to the public in the primary market and or listed on the stock exchange. Majority of the trading is done in the secondary market. Secondary market comprises of equity markets and the debt markets. For the general investor, the secondary market provides an efficient platform for trading of his securities. For the management of the company, secondary equity markets serve as a monitoring and control conduit by facilitating value-enhancing control activities, enabling implementation of incentive-based management contracts, and aggregating information via price discovery that guides management decisions. I hope you liked the video. If you liked the video, don't forget to like and share. Keep practicing, keep learning, keep growing.